Disclaimer. Stop what you're doing. I don't care if you're halfway through your morning coffee, flipping through charts, or scrolling headlines you won't remember by lunch. This is one of those moments where you either lock in or you completely miss it. Close the extra tabs. Silence your phone. Because what just happened in the silver market is not a routine pullback, not a healthy correction, and definitely not something you'll hear explained properly on the evening news. This was not normal. This was a structural event. And if you understand it now, it could completely change how you look back at 2026. Today is Wednesday, February 4th, 2026. While most traders were glued to 5-minute candles and arguing online about whether silver had gone too far, too fast, something far more important was unfolding beneath the surface. The silver market didn't simply fall, it snapped. And that snap created one of the most asymmetric physical buying windows Australia has seen in decades. Silver has just collapsed nearly 30% in a single trading session. Gone. Vaporized. A move so violent that you have to go back to the Hunt Brothers episode in 1980 to find anything remotely comparable. But here's the part almost nobody seems to grasp yet. This was not a collapse in silver's real value. It was a paper market purge. And while trading screens were bleeding red, something very different was happening in the real world, especially at the Perth Mint. As I speak, silver is trading around AUD $120 per ounce. Less than a week ago, it was above AUD $170. A drop of nearly $50 per ounce. Not because demand vanished, not because silver suddenly became obsolete, and not because the world discovered massive new supply overnight. It happened because leverage broke. And when leverage breaks, physical buyers get handed gifts. Here's the part you really need to hear. The Perth Mint is shipping metal aggressively. Production lines are running hot. Inventory is moving. And premiums, instead of exploding as they usually do after crashes, are compressed. That combination almost never happens. So let's slow this down and be clear about what actually happened. The crash was not caused by new information. It wasn't a demand shock or a technological disruption. It was positioning. On January 30th, 2026, silver hit an all-time high in Australian dollars, trading just above AUD $170.90 per ounce. Momentum was extreme. Every pullback was bought immediately. Industrial buyers scrambled. Solar manufacturers bid aggressively. EV supply chains were locked into contracts. AI data center construction was pulling metal off the market faster than refiners could replace it. Silver had climbed nearly 250% over the previous 12 months. Moves like that don't happen quietly. Under the surface, futures were packed with leverage positions. Hedge funds, momentum traders, CTAs, all leaning the same way. Margins were thin. Stop losses stacked tightly. It worked until it didn't. Late morning US time, liquidity vanished. A large sell order hit COMEX silver futures. Not due to new information, not because demand collapsed, but because someone needed to reduce exposure. That single liquidation pushed prices far enough to trigger margin calls. Those margin calls forced selling triggered algorithmic stops, and within minutes, a controlled market turned into a cascade. Silver fell from around AUD $170 toward AUD $100 in just over an hour. Over $18 billion in notional futures exposure was flushed from the system. That is not price discovery. That is mechanical failure. And here is the detail almost nobody on financial television is talking about. While paper silver imploded, physical silver barely moved. The Perth Mint did not see a wave of sellers. There was no panic liquidation. Instead, buying surged. Internal ordering data showed demand jumping more than 3 times the prior week, as average within hours of the break. Dealers increased allocations, long-term holders stepped in, large orders were quietly placed. This divergence tells you everything. This crash did not reflect collapsing confidence in silver. It reflected collapsing leverage. Leverage always exits first. Fundamentals follow later, if they change at all. This is where most people make the mistake of thinking a violent price move signals a broken market. Markets often move because positioning breaks, not because reality changes. Right now, we're witnessing one of the cleanest paper-physical disconnects in years. As of this morning, the Perth Mint is operating at roughly 98% capacity. Delivery times for popular products have stretched from 1 week to 3 or 4. Not because metal is unavailable, but because throughput is maxed out. 10-ounce silver bars are trading around AUD $1,215 per bar, about AUD $121.50 per ounce, premium included. Spot silver hovers near AUD $120. That's a premium of roughly 1%. In previous crises, premiums didn't compress. They exploded. In 2008, premiums exceeded 20%. In 2020 and 2021, physical silver became nearly impossible to source near spot. This time, the opposite is happening. Why? Because the Perth Mint prepared for volatility. Over the last 18 months, it expanded refining capacity, upgraded equipment, hired staff, and optimized logistics. Tens of millions were invested not to chase price, but to handle stress. They didn't predict the exact crash. They predicted the conditions. And those conditions are now here. Now let OS talk about why AUD $120 is more than just a psychological level. It AS structural. Global all-in sustaining costs for primary silver miners sit roughly between US $18 and $22 per ounce, or AUD $27 to $33. At AUD $120, silver trades around 4 times production cost. Historically, silver struggles to remain below 3 times production cost. Extended drops force mines to shut down, exploration budgets to be slashed, and marginal supply to disappear. That creates a natural floor. Production cost is only half the story. Industrial demand is the other, and this is where it gets uncomfortable for anyone betting against silver. The solar industry alone is projected to consume over 220 million ounces in 2026, up from 160 million just 2 years ago. Electric vehicles add tens of millions of ounces. AI data centers, power dense and metal intensive, require hundreds to thousands of kilograms of silver per facility. 3 years ago, this demand barely existed. Now it's structural. Supply? Not responding. Global mine output is flat to declining. New discoveries are rare. Environmental restrictions tighten, capital costs rise, and because silver is often a byproduct, higher prices don't instantly create more supply. That imbalance is the real story. Above-ground silver available for investment is roughly 3 billion ounces, mostly locked in jewelry, industrial inventories, and long-term holdings. Less than 500 million ounces are readily available for new investment demand. That's a thin market. Now imagine if just 1% of global investment capital moves into physical silver. You don't need mass hysteria. You don't need everyone to agree. You need a rounding error. And that's why events like this matter. They reset entry points without resetting fundamentals. Before moving on, understand this. This is not a promise of immediate upside. Markets do not move on your schedule. Silver could consolidate. It could chop sideways. It could even dip further if paper markets experience another forced liquidation. No one can call the exact bottom. But opportunity is not about certainty. It's about probability versus price. And right now, that balance has shifted. What happens next will not be decided by headlines or fear, but by who steps in when leverage steps out. Now let's focus on what really matters. Not the headlines, not the panic, and not the noise. But who is actually buying, why they're buying, and what happens after crashes like this when the dust settles. Markets don't bottom when everyone feels comfortable. They bottom when weak hands are gone and strong hands quietly step in. That process is already underway. One of the clearest signals right now isn't in price charts. It's in logistics, freight data, dealer allocations, order flows that never make social media but determine where price goes next. Over the past week, several of Australia's largest bullion dealers quietly increased their wholesale orders from the Perth Mint by 40 to 60% compared to late 2025 monthly averages. These are not emotional buyers. These are businesses that live and die by spreads, inventory turnover, and long-term positioning. They don't buy because something feels cheap. They buy because probability has shifted. International demand is surging too, especially from Asia. Shipping data shows outbound silver shipments from Australia to Singapore, Hong Kong, and mainland China rising sharply. In some corridors, volumes are up more than 80% week over week. This matters more than most, realize? Asian buyers have a long cultural memory with precious metals. They don't treat silver as a speculative trade. They treat it as stored labor, stored energy, stored value. When they see a violent paper liquidation without a collapse in fundamentals, they move quickly and in size. They've seen this movie before. Zoom out further. Silver doesn't exist in isolation. It exists within a broader monetary environment, one becoming increasingly unstable. Central banks are signaling more than they say. For 14 consecutive quarters, they've been net buyers of gold. Not sellers, not neutral. Buyers. They're quietly reducing exposure to paper reserves and increasing holdings of tangible assets. They don't buy silver directly in large amounts, but silver always follows gold. Gold moves first as the reserve asset. Silver moves second as the pressure valve. And when silver moves, it moves faster. Now consider the Australian dollar. Over the past 6 months, the AUD has weakened significantly against the US dollar. Even if silver prices stay flat in USD terms, Australian buyers still benefit. Silver priced in AUD rises when the currency weakens. You're not just buying metal, you're buying a currency hedge. If interest rate differentials persist, and there is little reason to think they want to guarantee, the AUD remains structurally vulnerable. That adds another tailwind to locally priced silver. Timing matters not because you can catch the exact bottom, but because multiple forces are aligning in the same direction. And the uncomfortable question always arises, What if this isn't the bottom? It's fair. Silver could dip further. It could test AUD 110. It could briefly touch lower levels if another wave of forced selling hits paper markets. Here's what matters. Risk versus reward. At AUD $120, downside is limited by production costs, industrial demand, and physical buying interest. Upside is asymmetric. If silver drops 10%, that's a paper loss of around $12 per ounce. If silver rebounds to half of its recent highs, around AUD $145, you packer up more than 20 per ounce. That's nearly a 2-to-1 reward-to-risk ratio in a conservative scenario. If silver returns to prior highs near AUD $170, upside grows. And if silver breaks higher in a renewed bull phase, driven by supply stress or renewed investment demand, the math becomes uncomfortable for anyone who stayed sidelined. Experienced buyers don't wait for confirmation. Confirmation comes after price moves, not before. Now let's examine what makes the Perth Mint different. Not all physical silver is equal. Operating since 1899, the Perth Mint has over a century of refining, assaying, and global distribution. Their products carry government backing for weight and purity, increasingly important in a world where counterfeits are sophisticated. Buying Perth Mint silver means more than ounces. You're buying credibility and liquidity. 1-ounce kangaroo coins remain among the most globally recognized bullion products. Right now, they're near AUD $123 per coin, premium included. Historically, that level disappears quickly after volatility events. Kilo bars offer tighter spreads for larger buyers. Premiums are compressed, a rare window to acquire physical metal near paper prices. That window doesn't stay open. In previous bull phases, first paper prices recover, then premiums rise, delivery times extend, and physical availability tightens. By the time headlines turn bullish again, the opportunity is gone. Right now, we're in the opposite phase. Paper markets have washed out. Physical demand is accelerating. Premiums remain low. Metal is still shipping. That combination doesn't last. Let's talk strategy. Practical positioning, not hype. Physical silver is not short-term money. If you might need cash in 3 months, don't touch it. Metals work best on a medium to long-term horizon. Decide your exposure. Coins offer flexibility and liquidity in smaller quantities, but slightly higher premiums. Bars offer efficiency, lower premiums, and better cost averaging. Many experienced buyers use a mix. Bars for core holdings, coins for optional liquidity. Consider staggered buying. You don't need to go all in. Buying in tranches reduces timing risk and emotional stress. A third now, a third in a few weeks, a third if prices stabilize or dip further. That removes the need to be right on timing. Storage matters. Home storage works for small amounts if done responsibly. Larger positions benefit from professional vaulting or insured storage. Some prefer immediate delivery. Others prefer allocated storage. What matters is eliminating counterparty risk. Allocated metal is yours. Unallocated promises are not. Let's put this into perspective. Imagine allocating AUD $10,000 into silver at current levels. Around AUD $120 per ounce, that's roughly 83 ounces, premiums included. Scenario 1, conservative. Silver rebounds to AUD $145. Your position reaches around AUD $12,000. Solid return without heroic assumptions. Scenario 2, moderate. Silver returns to AUD $170. Your position approaches AUD $14,000, meaningful gain in a tangible asset. Scenario 3, bullish. Silver breaks higher toward AUD $200. Your position grows to AUD $1,600 while still holding physical metal. Worst case scenario, silver drops 10%. Your position temporarily dips, but you still own the same number of ounces. Weight doesn't change, utility doesn't change, demand doesn't vanish. That's the difference between owning something real and trading paper claims. The best buying opportunities never feel comfortable. They feel quiet, uncertain, slightly wrong. Headlines after crashes always say the same. The move is over. The bubble popped. Demand is gone. Then fundamentals reassert themselves. Silver doesn't care about headlines. It cares about electrons in circuits, solar panels capturing sunlight, vehicles transmitting power, and systems needing reliability. Those trends are not reversing. Right now, the market offers silver at a discount because leverage broke, not because reality did. That's the distinction separating opportunity from noise. The Perth Mint shipping aggressively tells you informed buyers are already acting. They're not waiting for consensus. They're not waiting for green candles. They're positioning while the window is open. Windows like this close quietly and then all at once. You don't need to rush, but you must recognize probability when it appears. AUD $120 silver won't look obvious in hindsight. It will look inevitable. When people look back at early February 2026, they won't remember the fear. They'll remember the prices. The metal is available, the premiums are low, the fundamentals are intact. What you do with that information is up to you. And if you want to stay ahead of the stories that shape global markets before they ever reach the headlines, make sure you like this video, subscribe to the channel Economic Records, and turn on notifications so you don't miss what comes next. Because when the real signals move quietly, being early makes all the difference.